What's up, everybody? Dan again, Stocktrades.ca. Just going to jump right into the video today. It is getting close to bank earnings season, and in this video, I'm going to be going over the 6 largest banks in the country, providing our potential thoughts on what banks could be best moving forward. We're going to look at earnings estimates. We're going to look at projected future growth. We're going to look at current valuation. We're going to spot some outliers on banks that have been performing very well the last while and banks that have really struggled. And whether you're a American or a Canadian investor, it is absolutely critical that you know these 6 banks. The Canadian banking industry is one of the most heavily regulated industries in the world and is one of the fastest growing financial segments out of all the large to mega cap financial institutions. We saw this back in the 2008 financial crisis when the dividends actually stayed intact when many major players were slashing them. So with that being said, let's head right to the screen. I'm going to go to Y charts and I'm going to go to our Stocktrades Premium comparison tool, and we're going to dig into these 6 banks right now. So everybody, just before we get started, again, subscribe to the channel if you want to support us, like this video, and drop a comment below what your favorite Canadian bank is. More likes, more subscribes, gets us in front of more people, and allows us to create more great content. So in terms of banks, for the most part, you would think in a rising rate environment that banks would do well. And for the most part, when we look to 2021, when banks had that huge run, if we go here from January 1st, 2021 to December 31st, 2021, we can see that banks made huge gains. I mean, Bank of Montreal, 45%, Canadian Imperial Bank of Commerce, 41.2%. Most all of these banks made significant runs in 2021. But when we look to year-to-date returns, we can see that a lot of them are flat and a lot of them have taken a lot of damage. So why is that? For the most part, rising interest rates are good for financial companies. So when there was rumors that rates were going to start going up, banks went on a massive run. But typically when you are raising rates this fast, it's not going to be good for the economy. So as a result, the net benefits that a bank would receive because of these higher rates, which allow them to charge more on their loans and make more money, there's kind of a trade-off when the economy starts to weaken, because ultimately the benefits from those rising rates may be offset by lower borrowing. And if we look at the economic data right now, we can see that policy rates are up to 3.75%, and this is significantly higher than we saw at the start of the year. I mean, look at just February 2022. Policy rates were at 0.25, and now they sit at 3.75, and they are going to go higher. I believe we're going to see at minimum a 0.5% rate hike in December. So we're looking probably at a 4.25% policy rate. And as a result, spending could very well slow to a crawl, which is ultimately not good for these banks. And it has a real chance to impact the residential construction and the residential housing market, which are huge for these banks as well. In fact, it's one of the bearish theses right now is the overexposure to Canadian housing for some of these banks. I mean, when we look to things like the unemployment rate, Canada 5.2%, US 3.7%, these unemployment rates do not signal any sort of potential recession, yet we see inflation in the high 7% range. I've given my comments on inflation quite a bit and how, with the aggressive increases in policy rates, I'm mostly looking and tracking inflation on a month-to-month basis, and we are seeing inflation slow, so it's very likely we see these interest rates slow, and if things do settle and interest rates actually start to come down, borrowing increases, I can actually see lowering rates at this point being a little bit more bearish for banks than bullish. But let's head over to our screener and comparison tool and take a look at these 6 banks. I apologize for the smaller font on YouTube. It is fine on a web browser, but I do realize that these numbers are probably going to come in a little smaller on a YouTube video, so I will try to zoom in to mitigate the impacts of that. But when we look to these banks, most of them are actually borderline overbought because of the significant run-up in price, because of lower CPI in the US, lower PPI in the US, and lower overall inflation. If we look to the returns of these banks over the last 1 month time period, a lot of them have gained quite a bit. Toronto Dominion lags the most, but we can see banks like National Bank, Bank of Montreal, even Canadian Imperial Bank of Commerce, Royal Bank of Canada, they're posting near double-digit returns over the last month. So it's not surprising that they do have RSIs that are approaching overbought territory. In fact, something like National Bank is actually with an RSI over 70 is in overbought. So we could see these banks retrace over the short term, but I'm not particularly worried about that. RSI is a nice indicator for me that I use to time, say, entry points, but it's not concerning to me at all over the long term that these banks are a little bit overbought right now and have run up in price. Overall, with our growth score, we can see that Royal Bank of Canada actually scores the highest at 3.2 out of 5, and we're going to get into this a little bit more as we move forward down into the growth portion. In terms of our dividend score, TD Bank scores the highest at 4.4 out of 5. It is actually one of the highest rated dividend stocks over at Stocktrades Premium. When we look to shares outstanding and we look to actual buyback opportunities from these banks, we can actually see that buybacks have actually slowed in recent times. Over the last 5 years, most of them have bought back. We can see that Royal Bank has increased its shares outstanding by around 3.6%, but most of them are relatively flat. They haven't bought back a ton of shares, and this actually is in part due to recent times. I mean, we can see that even over the last 3-year period, there hasn't been much buyback activity. In fact, a company like BMO has actually increased its shares outstanding. And overall, when we extend it to a 10-year period as well, there's not a ton of buybacks involved with Canada's banks. They tend to want to increase the dividends, which in the end has benefited investors significantly over the last decade, and we'll get to more of that in the dividend portion of this video. So when we go down to valuation, we can see that on a forward price to earnings basis, the Bank of Nova Scotia is the cheapest Canadian bank. Now, historically, there has been a very strong strategy that you simply buy the weakest performing Canadian bank and the cheapest Canadian bank, and that will ultimately lead to outperformance moving forward. They tend to be the best performing bank moving forward. However, the Bank of Nova Scotia has essentially eliminated this strategy over the last 5 years at least. It's been one of the cheapest Canadian banks for quite some time. We tried to take advantage of this opportunity in 2018 when it was the cheapest bank. We essentially bought it in hopes that the strategy would hold true. Bank of Nova Scotia would outperform moving forward, but it has actually been a pretty significant laggard over that time frame. We can see here that it has really struggled to keep up with the other major Canadian banks. At best, it's underperforming by 37% when we look to Canadian Imperial Bank of Commerce. You can see a pretty wide gap here. This is why it is the cheapest right now, mostly due to underperformance. And I'm not a huge fan of Bank of Nova Scotia. Kind of a spoiler alert here. It is definitely not going to be my favorite bank moving forward. It's the cheapest right now, but I would not be purchasing it right now. I actually have been saying this for arguably a couple years now. I really think there's better opportunities. They really struggle in Latin America. They took a big bet there on their growth, and it just hasn't turned out. So we can see on a forward price to earnings basis, Royal Bank is the most expensive bank. This is not all that surprising. We are in a real risk-off market, and Royal Bank is the largest bank in the country. It has the most international exposure, and as a result, people would probably tend to drift towards a large cap company with exposure to a multitude of economies in Royal Bank. We can also see in terms of analyst estimates, it has the lowest upside potential in terms of target price. This is just directly from Y-Chart's analyst estimates, and this is their estimated price point for 18 months in the future. I put absolutely no reliance on this, but it is nice to know information. I do know that price upgrades and downgrades can tend to cause stocks to fluctuate in price in the short term. If there's a large notable upgrade, we can see an uptick in price. And if there's a analyst downgrade, retail investors tend to overreact on that type of stuff, so it can cause shifts in price. Most all of these banks have PEGs over 1, which is not that crazy. We could be heading into a recession in 2023, so earnings, obviously, they're probably not going to be the best moving forward, but the good thing is on a forward price to earnings basis, a lot of these banks are trading at levels that actually is pricing this in right now. Again, in terms of valuation, when we look to it on a charting basis, Royal Bank of Canada is the most expensive by actually quite a ways. After that, we have Toronto Dominion Bank. And then at the bottom of the totem pole, in terms of cheapest Canadian banks, we have Canadian Imperial Bank of Commerce and Bank of Nova Scotia. I really think CIBC is struggling right now, particularly because of its lack of international exposure. it is heavily exposed to the Canadian economy. It is expanding in the US. Companies like Bank of Montreal, TD Bank, Royal Bank of Canada, they've been doing this for longer. They're, I guess you could say, much more ahead in terms of expansion down south. So while Canadian Imperial Bank of Commerce is expanding down there, it does have a lot of exposure to the Canadian economy, and this is, in my opinion, exactly why it's struggling right now, and why it is one of the cheaper banks on a forward-looking basis. So in terms of profitability, Royal Bank and National Bank have the largest return on equity by actually a landslide, but the thing to note here is National Bank has the best return on equity 5-year average at 18.8%, and it's actually performing above its 5-year average return on equity. But the biggest notable look here is the Bank of Montreal. It has a trailing 12-month return on equity of 19.3%, but the biggest thing here is its 5-year average is 13.7%. This large of a gap just tells you that, especially post-pandemic, Bank of Montreal has really turned things around. And if we look to the actual increase in return on equity for the banks, we can see that most of them are either flat or even declining over the last 10 years. We can see that Canadian Imperial Bank of Commerce, their return on equity has actually dropped by 10.6% over the last 5 years. But we can see that post-pandemic, Bank of Montreal has been a clear winner. Their return on equity has increased by 57% coming out of the pandemic. And don't get me wrong, this isn't just a post-pandemic outlier for Bank of Montreal. Even pre-pandemic, we can see that it was one of the best companies in terms of return on equity growth out of these 6 majors. Now keep in mind, this chart is not total return on equity. This is simply their return on equity growth. If we go to actual return on equity, we can see here that National and BMO do stand out quite a bit from the rest. So when we look to profit margins, BMO stands out in a big way as well. Profit margins of 42.7%, but the biggest thing to distinguish here is their 5-year averages. On a trailing 12-month basis, they are significantly above their 5-year averages. And while we see most all other banks, they're all posting well above their 5-year average profit margins. Now, for the most part, these profit margins at BMO have actually come from non-interest bearing revenue. So let's take a look at BMO's annual report from 2021. We can see that net interest income actually didn't increase that much, which makes sense. Rates were low, activity was low in general, but when we look to non-interest revenue, this is really where the company stood out, and we can see large-scale increases across the board. I mean, we look at trading revenues. In 2020, $15 million all the way up to $296 million. Mutual fund revenue, we can see that underwriting and advisory fees grew by, looks to be just under 40%. When we look to non-interest revenue, we can see that it grew by nearly 15%. And I pulled up a couple other banks. I won't go through all 6. I pulled up Scotiabank and TD Bank. And when we look to Scotiabank's annual report here, we can see that much like BMO, net interest income in 2021 did continue to fall, but non-interest income also stayed flat. You're looking at just over 1% for Scotiabank in terms of non-interest income growth. And when we look to TD Bank, they actually perform much better than Scotiabank, but we can still see here that non-interest income, it didn't really grow that much. We're talking about 5% growth, which is still very strong, but is nowhere near BMO's 15% plus growth. And that is what has driven a lot of this overall growth and why BMO has performed so well compared to the other banks. So when we go down to the overall growth metrics, we can see that most of these banks, due to the pandemic, their EPS and revenue streaks have been reset. So we track consecutive earnings growth and consecutive revenue growth. So say, for example, CIBC here. Their revenue streak at 9 would mean that they have increased their top line revenue by 9 straight years. Whereas TD Bank, their earnings per share streak at 10, this means they have increased earnings per share for 10 consecutive years. So that's what these two numbers mean. In terms of a revenue situation, National Bank, obviously the most impressive. You're dating all the way back to the financial crisis. Even Royal Bank, pretty impressive, 11 years. TD's earnings streak is pretty impressive, and that is exactly why they've been able to grow the dividend at the fastest clip, and we'll get to that in a bit. When we look to 5-year overall revenue and earnings growth, we can see that by a landslide, National Bank has been the most impressive bank. We look to 5-year revenue growth of 8% and 5-year earnings growth of 22%. Now, this bank has struggled as of late, and I feel that's due to its Canadian exposure. It is expanding internationally, but the same thing, it's highly concentrated in Quebec. So I believe that the market is kind of adjusting the risk for this company's exposure to the Canadian economy. But there is no doubt that over the last 5 years, National Bank has grown at a crazy clip relative to these other banks. It's smaller. It was often deemed the growth stock of the financial sector in Canada, especially due to its reliability. When we look to the other major banks, though, considering these companies are large cap, the fact that Royal Bank, TD Bank, Bank of Montreal have posted double-digit earnings growth over the last 5 years, that is relatively impressive. These are large cap companies. I mean, Royal Bank is the largest company in the country. You're getting a lot of reliability here, and you're also getting double-digit earnings growth. When we look to a revenue basis, it's not surprising to see most of them growing revenue in the mid-single digits. But in terms of historical performance, this should give you a clear indication, which is why this comparison tool is so amazing over at Stocktrades, why the Bank of Nova Scotia and CIBC have struggled so much. When we look to 5-year average revenue growth of 4% for Bank of Nova Scotia and earnings growth of 6%, we look to CIBC, 7% revenue and 5% earnings. These two companies have significantly lagged Bank of Montreal, TD, Royal, National in terms of earnings growth. And with banks, earnings per share is absolutely critical. The growth of the bottom line is exactly what we want to see. It's going to fuel more buybacks in the future. It's going to fuel more dividend increases. And overall, these banks are, these large cap banks are mostly bought for their dividend growth. Now, when we look to forward-looking estimates for this year and next year, we can see that these banks are expected to post decent growth over this fiscal year, but we can also see that when we move to next year, many analysts are pricing in the recession that we might see in 2023. They're looking at low single-digit earnings growth for most of these banks. They're actually looking at shrinking earnings for a company like CIBC. And again, I've mentioned that they have heavy exposure to the Canadian economy. And same thing with revenue. They're not expected to grow revenue very fast next year. With these rates, we're likely to see a slowdown in the housing market. We're likely to see a slowdown overall as consumers really start to pinch pennies. Now, when we look to earnings expectations on a quarter-over-quarter basis, we can see that for the most part, revenue and earnings are expected to come in flat. In fact, a lot of analysts have earnings dipping over the next quarter. When we compare this on a quarter-over-quarter basis, we can see that Bank of Nova Scotia, they're expected to post a 5% dip in earnings per share relative to last quarter. The only one that is expected to eke out a little bit of growth is Royal Bank of Canada at 1.71%. In terms of revenue, they expect TD Bank to grow revenue by nearly 6% on a quarter-over-quarter basis. This seems a little odd, especially because earnings are expected to stay flat. But when we do look at TD's estimates, they are expected to post, it looks to be about $43 million in revenue growth. This doesn't exactly work out to be 6%, but this is still relatively strong growth on a quarter-over-quarter basis. When we head down to the dividend, which is probably what everybody cares about the most, Bank of Nova Scotia is an outlier on practically every front. The company yields the most because it's struggled the most, and I find a lot of investors are focusing on Bank of Nova Scotia right now, particularly those who focus way too much on income. They're buying this company because it's the highest yielding. In my opinion, we need to be looking at the overall state of the company. As we can see here, it has the highest payout ratios by quite a ways. It's expected to post the lowest top and bottom line growth moving forward. So there is a reason this company is yielding 6%. There is a risk-reward trade-off here when you get a high-yielding company like this. If you want to buy Bank of Nova Scotia because it yields the highest and you want that passive income, go right ahead. But I felt it was important to highlight the struggles the company has gone through and the struggles that are expected for the company moving forward. And that is probably why you're getting this 6% yield right now. Now, in terms of payout ratios, BMO, again, is the clear standout here. It's paying out only 24% of trailing earnings, and it actually yields the third largest, it looks to be here. I could actually see BMO overtaking TD Bank in terms of short-term dividend growth. If we look down here, we're looking at 5-year dividend growth of around 4.5% for BMO, while TD is near 8%. I have always liked TD, and it's always been one of my core holdings because of this high single-digit growth, primarily because of its strong earnings growth. But the performance of BMO over the last few years leads me to believe that BMO could potentially overtake TD Bank out of the Big Six as one of the fastest growing major banks in terms of dividend. Now, you'll see a lot of these companies either have 0% dividend growth or 0.34%, small dividend growth over the last 1 year period. We do have to remember that these companies, their dividends were frozen over the last while. So they, a few of them, just based on pure luck, were able to raise the dividend just because their typical dividend policies, they came in pre-pandemic. So this is why you'll see companies like TD, Royal Bank, they still have 1 year dividend growth. But most of these companies made up for this shortfall in growth with, as you probably know, massive dividend increases once the freezes were lifted. So overall, heading into this quarter, I know everybody's pretty much waiting for me to just say what bank I like best. In terms of my overall holdings, I hold equal weight positions in BMO, Royal Bank, and Toronto Dominion. I don't own CIBC, I don't own Bank of Nova Scotia, and I have regretfully never owned National Bank. But if I were to pick a single company in terms of earnings and what bank looks most promising, I would probably go with BMO. They had a relatively weak quarter. Last quarter, they missed estimates by quite a big range. They came in line with adjusted earnings, but revenue missed in a big way. And this was actually the first time that they've missed earnings by this wide of a margin in actually quite some time. On both the revenue and earnings front, we can see here that that was the first time that BMO had missed earnings estimates in we're looking at Q3 2020. All I can see for at minimum 7 quarters. So it'll be interesting to see if they can bounce back. Overall, I expect so-so earnings from all these Canadian banks. We are definitely heading into an environment that does not bode well for them. Overall, though, I do believe that a lot of them are priced in. I mean, the market is forward-looking. It knows the banks are not going to post high levels of growth moving forward. And as we can see with BMO, it is trading at a 21.4% discount to historical valuation multiples. So the banks have been, they've had a relatively weak year in 2022. We can see that price declines. This is the chart of BMO, but it's been like this across the board. There's a lot of economic hardship already priced into these stocks, in my opinion, and, buying them now and holding them for the long term. Historically, you have never gone wrong with doing this with Canada's banks, and I really don't think you're going to have a problem with it moving forward. So everybody, really hope you enjoyed the video. Overall, I really think that Bank of Nova Scotia, they've struggled mightily recently, and I'm not exactly sure that they will be the best performing bank moving forward, even though they are the cheapest. As I mentioned, it has historically been a solid strategy to buy the cheapest Canadian bank and the weakest performing Canadian bank because typically they do rebound. But over the last 4 or 5 years, Bank of Nova Scotia has broken this trend. It does have a chance to rebound, but so far its bets for growth in Latin America have not turned out. In terms of promising banks, it's hard to ignore banks like Toronto Dominion Bank and Bank of Montreal, but it is also hard to ignore the stability of Royal Bank of Canada, even though it is the most expensive right now. It has the most exposure globally, and if we are to enter a recession, it definitely has enough exposure to other countries to potentially mitigate the impacts of, say, strong North American exposure like a bank like Toronto Dominion. Again, I need you to smash that like button. I need you to drop a comment down below and subscribe to the channel. More subscribers, more comments, more likes gets us in front of more people and allows us to make free content like this, in-depth research on some of the most promising stocks in North America. Looking forward to bringing you more great content, and we'll see you next time.